everyone. So welcome to our next, yet again, one more episode of Ab India Karega Invest campaign. This is the initiative what we've been running on every Fridays. So today also we are back with a very interesting topic today. So building an all-weather portfolio using asset allocation strategy. To discuss on this, we have Mr. Arvind Chari. He is the Chief Investment Officer, the CIO of Quantum Mutual Fund. So he's here to join us to discuss and then throw light on how asset allocation would help us and what are the strategies we should really follow while considering markets like this. Okay, so welcome, sir. Looking forward for a great session, and we have Shikhar from Groww. So all three of us would be the panel members for today. I will start the session. Subsequently, Mr. Arvind and Shikhar would handle the program. After all three of us, we would open the floor for questions. Questions, zarur aap post kariyega. We'll be very happy to take up as many questions as possible once our time slot of talk is over. Okay. Let me just share the screen very quickly. So now what's been interesting is markets are going up. I think markets ऊपर जा रहा है. As investors, ये नहीं कह सकते completely happy है. No, there's a mixed emotion. One side is you're really happy because markets are going up. आपके portfolio में बहुत अच्छा returns दिख रहा है. But at the same time, there is also some kind of jitter. वो एक tension हो रहा है अभी market और कितना ऊपर जाएगा, कब crash होगा, पता नहीं. Like and then ये mixed feeling के साथ there are a lot of other investment decisions इसके ऊपर question mark आ जाता है that अभी और invest करें, is this the right time to invest, या कुछ पैसा निकाल देगा, should I redeem some money and then keep it. So 2021 में what is in store, क्या expect कर सकते हैं. This is generally what a confusion, a good confusion what we have started our 2021 with. Okay, so in order to address this, like let's say what I have done is in my part of the session, तो पहले हमने ये cover किया है markets are going up, but why markets are going up, and then subsequently asset allocation की जरूरत क्यों है और asset allocation करने के वजह से और क्या risk वगैरह cover हो सकता है. This is exactly what I would be covering today. Okay, so एक चीज जो है ये अभी हम जो market rally जो देख रहे हैं, it is not just a very a small or a narrow rally what we are seeing. It's a broader market rally. जब आप देखते हो like let's say May, June, July या August तक हमने जो recovery देखा market का, that was only a narrow rally. Few set of stocks, few set of sectors did very well, but majority of the other categories did not really so majority of the other like let's say categories did not really perform well. But whereas if you see subsequently from September, October onwards, it is the all other categories which actually really picked up, like let's say be it large cap, like a lot of other stocks or sectors which were lagging behind. There's mid cap which picked up, and then small cap. If you see in the last 1 month or 1.5, 2 months or so, small caps have really performed better than other two categories, that is mid and large cap. So this is the chart what I'm showing you for last 1 year, that is January 2020 till from January 2020 till January 2021, how each of the category, that is large cap, mid cap and small cap, have performed. Okay, so recovery phase, it is large cap which picked up first, and then subsequently mid and small cap took over the rally. Okay, so this is where you can broadly say that it's a broad market rally, that all the categories are going up. But the question which comes to our mind is, we are still going through COVID scenario, not just India. If you see some parts of the Europe, they're still struggling in a big time with respect to COVID. There is stringent lockdown which is happening in the Europe. But despite of all these things, why the rally in the stock markets, right? Have we really seen the economic recovery already? Have we back in the complete growth trajectory? I think that's one big question mark, I think, which all of us needs to answer. One of the main reason which we can point out for the stock market recovery is primarily because of what we call it as the actions taken by the like central banks across the globe. So what we call this as a easy monetary policy or a supportive monetary policy. Okay. So one of the most important tool which most of the central banks used to support the economy is been keeping the interest rates low, like let's say, and pumping in more and more money into the markets. The moment we contracted the COVID problem, like last year, that is 2020, March, April itself, most of the central banks across the globe reduced the interest rates drastically so that there is enough liquidity available in the market, which RBI also did the same thing by cutting down the interest rate. So you must be thinking, are cutting down the interest rate has got to do with debt market, but what has it got to do with equity markets? Imagine when interest rates are low, the money availability or the liquidity in the system goes up. The moment the money in your hand goes up, the equity market also starts seeing a good amount of rally because there is good inflow of money coming into the system. Okay, so in that way, you can safely assume that debt markets and equity markets are something are not like let's say not isolated from each other. They're fairly connected with each other, right? So whatever you are seeing in this particular chart, it is what happened in 2020. But what is expected in 2021? So what will happen to interest rates? Will it go up from here or will it go down further from here? If you see some of the expectation from the experts, okay, what I'm showing you is chart of one of the expert, that is Bloomberg's estimate. What they suggest is that most of the central banks, including Europe, USA, India, Bank of England, Bank of Japan, most of them are expected to keep the rates at the same lower levels. Okay, so that means no bank, central bank is in a hurry to increase the interest rates because primarily the inflation has not gone up and the unemployment situation has not solved to an extent which where a bank would be happy to see that. Like let's say where the employment recovery is pretty good, they've not seen the situation yet. Keeping these two very important parameters, we can safely assume that this year also the interest rates are expected to be low. And at the same time, central banks would be printing more and more money into the system so that there is a, like let's say, there is good amount of liquidity available in the hands of the investors. So you must be thinking, like I asked again, how is it linked to like let's say equity markets? Look at this very interesting chart. This is the like let's say investment trend among domestic institutional investors, that is DIIs, and foreign institutional investors. If you see over last 3 or 4 months, including January, if you consider last 4 months, primarily markets have gone up because of the good amount or the robust flow of FII money. Okay, so this robust flow is something which could be attributed to easy monetary policy or the supportive monetary policy taken by the global central banks. So if the expectation is, if this year also, if the global central banks are expected to continue with the supportive monetary policy, then we might not see the kind of knee-jerk reaction on the equity markets unless and until some other geopolitical factors like what, say maybe China or China India related issue or some other bigger problem faces. If the similar scenario persists, then there is the markets are expected to be in the similar lines. So this is what is happening, right? So one side equities are going up, whereas on the other side, if you look at our own interest rates on fixed deposits are still relatively low. Gold prices are coming down. Then many, as an investor, like let's say all these are big macroeconomic jargons what we're talking, but as an investor, what would matter to you and me is then what should we do with our money? Should we really pump in all the money into equity markets? The fear is, like what if it crashes? That's where it is very important for us to follow what we call it as asset allocation. So what are the different asset classes? That's what we will look at, and why asset allocation is important, and what strategy you should adopt for different scenarios is what we're going to look at in this particular segment. Okay, let me just take you through asset allocation with a very simple example. Imagine you love playing cricket and there is a cricket team what you're building, okay, and you are a batsman yourself, very good batsman. Just because you love batting, picking up all 11 batsmen to your team, like let's say 11-member team, but consists of all batsmen. What are the chances of your team winning that particular match, or winning every match, or on an average consistent performance of your team? Very less likely, right? I mean, just because you have great batsmen does not mean that you're going to win the matches all the time. Which means if you want to make a great team, it needs to be balanced, as such. So what brings the balance to the team? You need to have batsmen, but within batsmen also you will have different categories, right? I mean, someone who is a pinch hitter, someone who stabilizes the innings. It's like you need Rishabh Pant as well as Cheteshwar Pujara as well. You need to have both of them in the team. You need bowlers. Within bowlers, you need fast bowlers, spinners, and you need wicket keeper and fielders. Only then it becomes a complete team and a balanced team. Okay, so that is exactly what makes a big difference in your portfolio construction as well. Just because equities are doing very well, the moment you start withdrawing money from other investment options or other asset classes and then start investing money only in equities, that's where you start increasing the risk of your portfolio. You need to have a good balance between all the three, right? So now, what is that good balance is what we will look at. So when we say asset allocation, the very important factor which all of you should understand, that not all the investment options would behave in the same way for a given market condition. Okay, suppose if the market conditions are very bullish, like right now, the interest rates would be relatively low and gold prices would be going down. So that means there would be at least two asset classes which would be moving in two different directions. So we call this as negative correlation. That means this goes in opposite direction. So that is why it is very important for us to have a right mix or a good balance. Okay, so what are the different asset classes? We have equity, we have a fixed income. So when we say fixed income, this includes fixed deposits, debt mutual funds, all those things could be put under fixed deposits. Then gold, primarily we could look at these three asset classes into our decision-making matrix. Okay, now let's just take up three broad scenarios. The first scenario being that as an equity investor, you are very sure that equity investments are not something which is recommended for short term. I think this is something even in Ab India Karega Invest campaign, we've been talking about it from a long time, that be a long-term investor. Okay, if your horizon is 1-2 years, maybe equity is not recommended. If your horizon is only 5 years and above, or maybe 7 years and above, then equity is something which is recommended. So as an investor, if you want to look at investing in, for long term, what if your portfolio is 100% into equity? Okay, that is one scenario what we are taking into consideration. The other scenario is, along with equity, what goes well? Okay, what complements equity? I'm sure all of you would have heard of it, or you would be aware that what complements equity is gold. Okay, so when you mix equity and gold, right, it gives a nice balance, because every time equity market goes down, gold prices go up. So it is actually, let's say, protecting your portfolio from such market losses. So what I have done is, I have taken example of, let's say, two multi-cap funds, okay, and with equal weightage, that is 50% weightage. If I have 100 rupees today, one scenario is I'm investing 100 rupees into that particular basket of multi-cap funds. The second scenario, that is the asset allocation scenario, what I have worked out is, out of 100 rupees what I have, I'm investing 70 rupees in multi-cap funds. But again, that 70 rupees also in equal weightage, and the balance 30% I'm investing in gold ETF. Now, I'm sure you would want to see how this asset allocation would help you in the risk reduction. Okay, let me show the performance chart of these two, that is 100% equity portfolio versus asset allocation, how they would have performed over years. Okay, look at this chart. I have taken the data from the calendar year 2007 till 2020. The blue line represents pure equity, that is 100% equity portfolio. So if you see 2007, it opened very well. Your 100 rupee invested on January 2007. At the end of 2007, it is worth 164. That's a great return what you would have got. But at the same time, your asset allocation basket would be at 149. You would be unhappy because equity markets have done very well, whereas your asset allocation basket has underperformed heavily. But look at what happened in 2008. In 2008 market crash, okay, the 100% equity portfolio from 164 rupees is down to 95. That means you're already in losses, okay, just in a matter of 1 year. Whereas your 70-30 asset allocation basket is at 116. That means we are not saying you'll not incur losses at all, but the volatility or the quantum of losses would go down. That is the beauty of asset allocation. So if you look at the orange line, that is the asset allocation line. So if you see, that is little more consistent compared to the blue line. That is all 100% equity line is relatively highly volatile than the orange line. Every time markets are crashing, if you see, orange line is standing out, but every time markets are rallying, probably like blue line, that is 100% equity, is actually going up. So don't expect that in every market condition your asset allocation would stand out from the pure equity portfolio, but your intention should be not just getting the returns, but to get that returns, your overall portfolio risk should be low. Okay, that should be the main intention of investing in asset allocation. So right from 2007 2020, if you see, that 100 rupee what you invested in pure equity portfolio would be worth 607 rupees, which is not bad. In 14 years, 6 times. Okay, whereas your asset allocation basket is at 675 rupees. So despite of taking relatively lower risk, your returns are poised to be in a better phase. Okay, so what we say is risk adjusted returns is slightly better for an asset allocation portfolio. So that is the sweet spot which all of you should be in. Okay, that's how you protect. So if you could broadly look at maybe 70-30 or 80-20 kind of a asset allocation ratio if you're looking at long-term horizon of investing. But at the same time, the moment you make it 50-50, that is 50% in equity, 50% in in gold, then your overall returns would come down, because when the market goes up, you're not participating in the equity market rally. So remember, asset allocation means you're mixing two asset classes, but you should get the right blend or the right mix. Only then your portfolio would give you decent or a good returns with risk reduction. Okay, so that's one point what you should keep in mind. And when we say asset allocation, part of the strategy is fund selection as well. Which category of funds you should really look at investing. Now, if you really look at last 2-3 months, small caps have done exceptionally well. Suddenly you get that feeling that, array, let's invest in small cap. Why invest in large cap? Because large cap returns are lower, small cap returns are good. And in general, what we do is we go and search onto Google and then say best performing segment or mutual funds, and then we make our investment decision. Again, look at the performance of large cap, multi cap. Okay, that is BSE Sensex is performance of large cap. BSE 500 is like multi cap performance, and BSE mid cap and BSE small cap. Right from 2006 till 2020. Okay, complete calendar years, which means we are talking about 15 years return. The CAGR is, if you see, they're in the range of almost 8% to 11.5%. Okay, but look at the risk involved. For large cap, 11.5% CAGR for 15 years, but at a risk of 31% of standard deviation. But whereas for small cap, the standard deviation is 51. That means essentially it means the risk involved in small cap is significantly higher. Okay, that means small cap as a category carries very high volatility compared to large cap or multi cap. Okay, this is where even in your portfolio construction, you should be very clear of this one particular assumption, that high returns does not necessarily, high risk does not necessarily means high returns all the time. Okay, so this is where you go for a nice blend of funds. So even with an equity, create your all season funds basket, that is large cap funds, multi cap, ELSS funds, and mid cap funds. These are some of the funds which could be part of your all season funds basket. Okay, I've just taken an example of 3 funds. These are actual funds. over last 270 months, if you've done 9,000 rupees SIP into each of these funds separately, say in this, I have taken a large cap fund, which is below average performing fund. Multi-cap is above average performing fund. And this particular mid-cap fund has done exceptionally well. Your 9,000 rupee SIP for 271 months in large cap fund, the value would have been at the end of 271 months. That means a little more than 20 years, would have given you 1.78 crores. Mid cap would have given you 3.83 crores and 2.69 crores in multi cap fund. Look at the returns difference, 15% to 20.5% return. I'm sure as an investor, you would have been happy with 15%, but look at the difference between 1.78 and 3.83. A good mix. I'm saying in the fund selection, not necessarily all the times you would be part of best for funds. Let's say out of 3 funds you've invested, one is best performing, one is average, other one is below average. Even if you had given equal mix to all these 3 categories, like let's say your portfolio value would have been 2.77 crores with a CAGR of 18%. So that is why when we talk about asset allocation and when we talk about selecting the funds, remember you need to have good mix of funds. It is always the basket of funds which will really help you in generating that kind of portfolio returns as well, and overall portfolio risk also goes down to that extent. And my last point here is, suppose if some people, like let's say you've been investing in last 10 years, 15 years or so, and your goal is approaching. Suppose you are retiring next year and you have saved the money for your retirement. Probably this is the time you start doing the reverse asset allocation from equity. That is, slowly start withdrawing money from equity and then slowly start moving into debt, because you have just 1 year to go for your goal, or maybe 1.5 years. This is the time you could slowly start doing SWP, systematic withdrawal plan, because the challenge is next year that like you waited and then what if market goes down? So you don't want to be in that scenario. So from all these scenarios point of view put together, asset allocation plays out a very, very important role. There are different strategies which you really look at following, be it systematically investing or systematically withdrawing. That's something which would really help you with respect to portfolio construction. Okay. So on that note, I would like to conclude my session part. So I would like to invite Mr. Arvind to take it forward from here.
Karthik, thanks. That was very nice. Before I just,
Mr. Arvind, your voice is not audible.
Can you hear me now? Can you hear me now? Okay. Before I start my presentation, just one clarification. I am the Chief Investment Officer at Quantum Advisors, which is the parent company of Quantum AMC, which manages the Quantum Mutual Fund. Let's just dive into the presentation. I'll try and keep my presentation as quick as I can so that we can take as many questions as we can and make it as interactive. So Karthik covered quite a bit in detail about what asset allocation is. And if you look at this graphical representation, this is on global, right? Globally also, asset allocation matters, and this is why it matters. If you look at the red colored thing of MSCI Emerging Market Index, look at how it has moved. Yeah, every year either it's the bottom or it's in the top. So if you have very high allocation as a global investor to the emerging markets, you're going to have heart attacks, right, over a period of time. So that's when you start thinking about how do I size and how much should I invest in a particular asset class, and that's the reason why you need to have a mix of US Treasuries, that is fixed income, gold, which is your portfolio insurance, and equities and debt, and a mix of that, right? It's very important in India also, and we've just as Karthik did, I just kept it very simple into gold, Sensex, and bonds. And here also you can see why it matters to have a long-term asset allocation across 3 asset classes. And the reason we've been advocating a high percentage of portfolio into gold, and the way we look at it is you should buy gold and hope that it falls, because gold is as was said before, it's a negatively correlated, right? So if gold does bad, if that means it falls in prices, which means that the economy is doing well, your job is doing well, your business is doing well, you're earning well, your equity portfolio is doing well. So it's kind of as you talk about a portfolio insurance in some sense, right? And then you need some exposure to what we call fixed income. Now, globally, fixed income is no longer a diversifier. And I'll show you through charts why so, that interest rates are so low and so negative that fixed income was supposed to do the job of trying to keep your risk as low as you can and try to earn that extra return. And in that, I will also talk about credit funds, and I'm sure somebody will ask me a question on credit funds, and I'll happy to take that as to why in a fixed income portfolio, your goal is to keep your money safe and liquid and not try to earn that extra return. Wealth generation happens through equities, so remain invested in that. Wealth protection in some sense, or a cycle protection happens through gold, and that gives you that steady, liquid, safe return over a period of time. So keep that in mind when you're looking at asset allocation. I don't know whether you're able to see this, but you can look it up. This is done by the Mint newspaper. They do it every year. This is called the Asset Allocation Quilt. So they do calendar year returns of all asset classes. This includes even real estate. The funny thing, if you see, in terms of people who are thinking about, can I time my asset allocation? So if you look at the, the asset class which kind of performs badly in one calendar year tends to do well, if not the next, but in the next 1 or 2 years. So, in terms of timing, if you're really wanting to be smart about your investments and you get the kick by, timing your investments, you can in your mind, you can think about these things and try to see it over a period of time, how certain asset classes move, and you can time it accordingly. If certain funds have done very badly, certain categories have done very badly, then look into it, research it if you can, or look for a mutual fund or a fund which kind of gives you exposure in that. I used to tell very often in fixed income that, typically when you get double digit returns in fixed income, like in a gilt fund gives you double digit return, be skeptical, because, interest rates have fallen, prices of bonds have gone up. That's why gilt funds have given you double digit returns. And do you expect that to happen again? So these are things that you need to ask yourself. I will give you a simpler solution, but if you're someone who wants to do it on your own and you understand these things, then these are the aspects that you need to think about in terms of where are the returns coming from, what has happened. And last year was amazing, right? I mean, who would have thought that the way the markets corrected between Feb and March and where we ended in the year. And this table itself, this includes international assets, it includes the domestic equity bonds and the rupee. And it's an answer in itself. It teaches you and tells you a lot itself, how you would have behaved in Feb and March, what changes you made or what investments you made or what you sold in March, and what are you doing right now when the equity markets are at peak and even bonds have done well. So, this is where the behavioral aspect of investing comes into picture. And what we are trying to do to have an asset allocation is to keep your behavioral aspects away and follow a simple but a very disciplined approach to invest, so that you are not really bothered about this. In fact, if your asset allocation is very clear, you would have taken advantages of situations that markets give you. So don't be afraid of the markets, but try and be in a situation where you can use the market volatility and market changes to your own advantage. But before that, let's understand why asset classes move the way they do. What drives movements in asset prices and movements in different equities, bonds, real estate. And it's these are common, these are global. Some of you know it, and this is very general monetary policy. What central banks do, what governments do, what investors do, whether investors are investing in small cap or removing away. And I'm talking about investors, institutional, and now includingly, increasingly even retail. What are global investors doing? Are they investing in emerging markets like India, or are they removing money from emerging markets like India? And very general investor positioning, right? You sensed fear in the markets in March March 23rd, markets bottom. March 9, 2009, markets bottom. If you can sense that, those are all the things that drives market. Whether you're in India, in the US, or anywhere in the world, these two determine most things that happen across asset classes in the short term and in the long term. Of course, India is kind of less correlated, not impacted by global, but that's only true to a certain extent. What the US Federal Reserve does through interest rates. So if they keep interest rates high, and foreign investor does not need to look for returns in other destinations. They can remain invested in the US and earn that 4-5% return that they can get from US treasuries. When the US interest rates go down is when they start looking at, okay, I'm getting only 1% in my bond portfolio in the US. Can I invest in China and get 3? Can I invest in India and get 5? Can I invest in Indonesia and get 7? These are the decisions that they start taking. And the other aspect that drives it, both for a US investor and for a global investor, is where the dollar is. So the dollar is strong. The US investor is more likely to keep the money in the US. Foreign investors are more likely to invest into the US because the dollar is stronger against the euro, against the INR. And when this dollar starts weakening or depreciating, is when investors start looking at currencies which will benefit from that depreciation. Right? Emerging markets will do well. Emerging market currencies will do well when the dollar is in a weak trend. So this is the broad trend, right? Right now also, as we speak, the two themes of investing, and I've written about it, and you can Google it on our website, that interest rates will remain low and the dollar will weaken. And you've seen maybe the first signs of what was shown by Karthik also in terms of flows, right? Foreigners have started investing in a big manner in emerging markets in India. Maybe these two trends are kind of driving it. And when these things are used by the central bank, so central bank prints money, and you can see the chart on the right, it's off the chart, right? We've never seen such kind of printing of money and low interest rates in the world. And when these money printing and money is used by governments to increase debt, and as governments increase debt, they kind of increase spending in the markets. They are right now, if you see, India is giving Narega payments. India has made some Jan Dhan transfers. Globally, you've seen governments paying people's salaries, right? Because they've not been able to work. And as that happens, so low interest rates, very high liquidity, weak dollar, and an increase in spending by governments. And maybe that's why it is surprising, but it's not as surprising to see the economic recovery that we have seen over the last 3-4 months. In India, the most important thing is growth. India is a growth economy, right? We are very, very confident that come what may, India will grow at that 6.5-7% returns, so GDP growth over a long period of time, which has not happened in the last 3-4 years, and that's a worrying sign. But investors, domestic and global, look for that growth that is there in India to be invested in India. And this table kind of this is not a guarantee. This is just a framework in why we should remain invested in Indian equities. If the GDP growth is able to grow at 6.5% and we get 5% inflation, nominal, what a nominal GDP grows at 11.5%. If you allocate GDP growth to revenues of companies, then company revenues grows at 11.5%. Companies which are in the index or which are in the BSE 200, BSE 500, better companies, much better managements, great products, good brand, they will tend to grow at a higher pace than the overall economy, right? So this is how this is how you build your expectations, that you kind of in your mind know that, okay, if the growth is X, this is what I could expect over a long period of time from the Indian equity markets, right? If that 6.5 becomes 4, then you kind of, you have a situation where your returns might not be as high as say 13 or 15%. And if you look at a long period of time, like since the inception of the Sensex, you would have got somewhere between that 13 and 15% returns. This is not a guarantee. You're not going to get it every year. And the challenge is growth. If growth falls in India, then maybe you might not be able to get that return, and you'll have to get satisfied with a slightly lower return. Same thing happens in interest rates, and low interest rates tend to have changes in behavior. When FD rates are low, people starts looking for options. And that is what maybe happened after demonetization. When FD rates went down, people wanted to get that extra 1 or 2%, and you saw a big investment in credit funds. And the problem was, when the economy goes down, credit funds do not do well, and you've seen the impact of that in with investors, and quite a few investors got hurt, unknowingly or knowingly. But this is what happens when when markets drive investor behavior. On the right is the home loan. We've never seen home loan rates at these levels, and there is a high possibility, and many would already be doing it. Take advantage of the lower housing loan and housing EMI, and start investing in, or buy a property, not for investment, but for staying in. Everybody now wants an extra room. So, interest rates, low interest rates can also change investor behavior. We have seen that significantly in the global markets, where because there are negative interest rate, the way people behave to negative interest rates is very, very different. And that impacts markets over a period of time. We all know this. Some younger people might disagree with this, but this is what you do, right? You earn, so you have income, so you consume, and then you save, and then you always have the choice between whether to save today and consume tomorrow, or consume today and save tomorrow. It's very behavioral, but there are certain things that you need to ensure that you save, and you save for good. I saw this graphic. I love this graphic. I saw it on Twitter, and so I don't know who this belongs to, but this is a very nice way. We tend to overthink, right? We tend to overcomplicate, and also financial services companies like us, we try to complicate a very simple act of investing, because when you complicate, you tend to feel that you're a smart, or you have a better product, and you know more than the others. And this is what investors also do. They look at returns as an indicator, but do not think about how they want to do, how will they behave, what kind of risks can they take, how much time do they have to be able to achieve what they want to achieve. So this is a very important slide. So what should you do? So I will break it up into sacred money, investment, and then play. And everybody wants to get that cake by, broker has given me a tip and I want to wager that tip, and I want to buy that small cap company, or I want to buy a credit fund. I want to make higher returns. But overall, if you look at in a pyramid, keep your play money, which is your kick money, as small as you can, and add to a limit where even if you lose that money, you're not going to lose your sleep, and the rest you keep it sacred and invest. And I'll tell you how. So this again shifts, right? When you're young and you have money in your hand, but you're young and you don't have responsibilities, of course you would want to have play money or spending. But as you have family responsibilities, as you have house, and when you buy a house, or you expand your family, then of course you need to be a bit more cautious in terms of how you save, invest, and carry your financial liabilities. This is extremely important, and a lot of you would have realized this if you didn't realize it before. During COVID, jobs can go. Jobs are not guaranteed. Medical situation is not guaranteed. You can suddenly, by the whim of a government decision, you are hale and hearty, but you just can't work. And that's why it's very, very important to create this emergency fund, and keep it as safe as you can. You want to keep it in cash, you keep it in cash. You want to keep it in a liquid fund and a bank savings account and everything. This is a money which should not be at risk at all, and it should be available to you at any point of time. And only when you create this, or you are certain that you are reaching that, should you even think of asset allocation, or should you even think of investing in equities and gold. And first create this emergency fund, settle yourself, and then start thinking about asset allocation. Karthik spoke a bit about this in terms of short term. When you have short term, how do you allocate? When you have medium term needs, how do you allocate? I'll try to make it even more simpler. This is what we do, and this is what I follow. This is what many in quantum follow. This is what we've said, the 24-80-20 rule. So 24 months of your expense. For some, it could be 6 months of their monthly expense. For some, it could be 24 months of their monthly expense. It depends on what job you have, what business you run, what kind of other social safety nets you have, family, inheritance, house, which you can liquidate. So figure that out. Keep, whether it is 12 months, for me, it's like 12 months. I've kept 12 months of my monthly expense in a very safe, in a liquid fund. I don't touch it. I don't look at it. It's always there. And I know I have the peace of mind that even if I don't have a job, or I don't have salary, or I don't have income, I can sail through for at least 1 year. And after that, I, we recommend just do 80-20. Now, of course, age wise might differ, but for many, for the majority, if you do this, a lot of your problems will get solved. You have an emergency corpus which is safe, you know you're not going to lose it, and the rest is 80% in equity funds and 20% in gold. And gold, you can figure out whether you want to do gold physical, ETF, sovereign gold bond. Equity, you can figure out whether how much you want to have in large cap, how much you want to have in mid cap, small cap, or how much you want to do in international, how much you want to do domestic. But just following this solves a lot of the problem. And today, with entities like Groww and all the other platforms, this can be done in a click of a button. This is not complicated. It's very, very simple. You can replicate this without any advice, or if you want, you can always take advice and do this. But it's very, very simple to do this. And I still think that forget about market timing and forget about where markets are. If you just follow this approach, and if you have that 10, 15, 20 year horizon for your retirement or for your investments, this will solve a lot of the problems. Of course, you have very, very short term goal, like you want to make a down payment for your house, then of course this will not work, right? If you want to save for your car, this doesn't work. But general investment portfolio which you're creating for wealth creation, first save your emergency corpus, and then invest 80-20 into equity and gold. And of course, so your emergency corpus is your fixed income, and your equity, and then 80-20 is in equity and gold. How do you time asset allocation? Now, can you time, should you time? So one timing is rebalancing. So say the same example, 80-20 into equity and gold. March 2020 happens. Your portfolio would have, equity portfolio would have gone down, gold portfolio would have gone up. That's one way to rebalance, right? If you're aware of all those things and it's available for you, those information, and today you have portfolio trackers everywhere, it's very easy to track it. You can rebalance. When you got a big bonus and you want to make a lump sum investments, at that time you can time your asset allocation. And when I'm saying timing, you can also choose if you're allocated more to large caps and you've seen that small caps have fallen so much in 2019, maybe at that time you can increase your asset allocation into small caps within your own framework. So these are the ways you can time. Valuation basis, of course, you can look at equity markets against equity and debt. So you can look at equity market P, and you can look at bond market yield. These are also not easily available, but there are enough tools for you to be able to see what kind of valuation. You can look at within equity, how small caps valuation over large cap, and should you have a higher allocation to small cap. You can look at global, right? If you're investing in global markets or international equities, you can look at whether should I make a slightly higher allocation. If you have a view on if the markets experts are saying that rupee is going to depreciate, you want to make the higher allocation to an international asset. So these are the way you can time. I'll take my own personal example as the way I have thought about my asset allocation. It has taken me some time. It's not that I did it 20 years back. This is what I've done over the last maybe 10 years. So I have term insurance, which covers 2 times of my home loan. So if something happens to me and I die, my family retains the house, and they also have enough to cover themselves. I think this is very, very important. It gives me a lot of peace of mind. Of course, I have medical insurance also. As I said, I've kept my 12 months of my expense as in bank savings and liquid fund. My investment portfolio, so I've kept retirement and investment separate, and I'll tell you why, is, as you can see in the screen, 73 in equity, debt is 21. As you would guess, a large chunk of my money is in quantum funds, but I also have other allocations. I have a very low allocation to gold, and I've never been able to do it because in my mind, I'm a timer, right? I've tried to time investments into gold, and that's a mistake that I've done. And I've had slightly lower allocation to gold than what I would have wanted. What I do for my retirement is NPS offers you tax benefit from your salary. So 10% of my basic, I just put in an NPS, and even there, because it is long-term, 20, I'm 40 now, so 20 years to go. is 75% equity, 25% debt. That's the maximum that NPS allows. And because NPS is invested in index fund, on my normal investment portfolio equities, I have chosen active diversified equity funds across large cap, a mid cap, and a small cap fund. I tend to do lump sum investment, but I also have SIPs. Timing, right? People want to time. What I do for my timing is I look at sector funds. Because compliance wise, it is easier for me to do a sector fund within quantum than a diversified equity mutual fund. And it just gives me that kick that I want, that I am smart and I'm looking at the markets and I can time the market. So whatever timings that I make, I don't invest in direct stocks at all. All my portfolio is in mutual funds. And whatever I need to time, I time it through sector funds like auto, pharma, IT that I've done over the last 3-4 years. Important thing there is you need to figure out when you want to enter, and you also need to know to exit, because sector funds, if you hold through a full cycle, it seems like it doesn't make a lot of sense. So you time it when the market and the sector is not doing well, and you try and exit. So you can think that I'm just giving you because a lot of people want to time. Otherwise, ignore all these things. This is not necessary. I also do less than 10% of my portfolio is into sector funds. For my daughter, now she has an even long runway. I do SIPs and I do lump sum, and it's significantly in equities. This is something that I learned from. So my wife is getting inheritance money from her father, and so her father is 70, and he wants to distribute money to both his daughters. Initially, because we always think in our mind that old person, senior citizen should not have too much in equity. So we had a very high debt equity mix. But I changed that over the last 3-4 years, because that money is not going to be used by him as a senior citizen. He has his money. He knows he has his resources. This is what he's giving to his daughters, who are both in the 30s, and they have a long run. So they can invest and stay invested for 15-20 years before they need that money, right? So we've kind of flipped it to say have more equities, and we've used this market, that February, March, fall to increase that equity exposure. So this is my personal example. I will be happy to take whatever questions you have. And I think Shikhar is going to speak to you next. Thank you so much.
So thank you, Mr. Arvind. So in fact, there's a small technical issue with Shikhar. His internet connectivity is pretty bad. So if you're fine, we'll jump into the Q&A session.
Yeah, absolutely. I'm happy to do it.
Sure. Fantastic. So I think markets have been really exciting since last year, right? I mean, yes. From March, April onwards, the kind of lot of new learnings what investors and us we are getting is phenomenal. There's one interesting trend, my own, say, brother-in-law, he's working in one of the tech firm, and he got good amount of savings because he shifted out of the place where he was working and he shifted back with his parents. So he's a good amount of savings left. And now what he's saying is, he told me, Jiju, I think, look at how US markets have performed. I'm doing SIPs in some of the US-based funds,
Yeah.
So it's a phenomena which is picked up only since last year, right? I'm sure in 2018-19, very few of us would have spoken about investing in international markets.
Yeah.
So according to you, what do you think the right way to invest in US markets? Should we invest at all? If yes, how much? And then what could be the right way? Should they look at investing in some index funds in that country? Or should they take that risk and invest in some actively managed funds? So what's your take, Mr. Arvind?
So the way I see international investments, I think one major reason is child education. So if you think that your kid is going to get educated abroad, and you know that the rupee tends to depreciate between 2 to 3% every year against global currencies, right? So if you want to that depreciation, is one way to look at some asset which is not INR linked. So one asset is clearly gold. Gold is linked to dollars. So when the rupee depreciates, even if gold price and dollars are flat, the gold price in INR will increase. So that you can just do gold and get that diversification against the INR depreciation. I would also argue that some amount of allocation may be required to international allocation. But in terms of, if you look at international fixed income, now Indian rates, Indian interest rates are much higher than international rates, and it's going to remain like that. So that kind of is pointless unless you are a HNI and you want to move abroad and then you want the dollar allocation. That's a very different. But if you are going to be in India and your investments and work is in India, then global fixed income is doesn't make sense. Global equities may make sense, but if you believe in the India story and that, that table that I showed, 6.5 plus 5 plus 11, 13, if that is a compounding that Indian equities can give over a long period of time, then substantial amount of money should remain in India. And you can have that extra allocation. Yeah, and especially for the child education, you can mix it between gold and international equities. In that, I would say, see, in India, you might choose 3 or 4, 5 active funds. Whereas when you're investing internationally, I don't know whether you will be able to choose 3 or 4 active funds. So the best way to do is, I think it's ETF, just or a index fund. So just choose a low cost international ETF or a low cost fund. Today you have broking accounts which allow you to buy international ETFs. Vanguard ETFs are like very cheap. So you can do the Vanguard, the US or the Vanguard Global, very cheap, very low cost, very easy to transact and get in and get out. So yeah, that's my take on it.
But then, what kind of allocation you recommend Indian equities versus say foreign equities?
I would say 5 to 10% max.
5 to 10%.
So if your goal, if you follow the 80-20 of that, what we are recommending, 80 equity, 20 gold, and emergency corpus, of that 20 gold, maybe you can look at 15 gold and 5 international equity, because remember, gold is also a insurance to your equity portfolio, right? It's not only for the depreciation of the rupee. So maybe you can do it that way.
Sure.
If you're very, very sure that you have 2 kids, both kids are going to go abroad, then you can increase that allocation to slightly 10-15% because you know you will need that money in dollar terms.
Sure, definitely. So thank you. I think let me just take a leaf out of what you mentioned when you said a couple of Indian funds and so on. There's one very interesting question. What should be the right mix and what allocation should be given to say large cap, mid cap, small cap? And how many funds you think is ideal?
India does not have fund of funds. I mean, Quantum has one, but there is not many. Globally, fund of funds is very big. So this problem of which equity stock to buy, that's why I buy mutual fund. Now, which mutual fund to buy, that problem always remains, right? Ideally, for someone who is busy with their work, but they just want to invest in equity, fund of fund is great. An equity fund of fund allows you to allocate between large cap, mid cap, and maybe small cap funds. And so then one investment is kind of is enough, right? You might still want to add some sector or some value or growth fund and all those things. But technically, if you want to make it really simple, you can just take an equity fund of funds which is diversified across large cap, mid cap, and small cap, and that's your equity exposure. If you don't want to do that, it's very difficult to give a range. But as you showed in your long-term return, right? Large caps have given more return at lesser risk. Now, of course, timing, where you start, where you end matters, but it's always true. Over a long period of time, small caps, when you enter at the right time and exit at the right time, you will make tremendous money. But if you don't do that, then you should have a very high allocation to large cap. I would say in your 100% equity portfolio, 60 to 70% could be large cap. The problem in the mutual funds that I see is now the categorizations are so tight.
Yeah.
Even this multi-cap fiasco that whatever happened in December. I mean, so you don't really have a fund manager which kind of straddles across caps. Okay. And find a good fund which can do that. Then that's the ideal thing, right? Which is why so because you can't do it and it's not easily available, maybe 60-70% large cap, then some multi-cap or mid-cap, and then some small cap. But mid-cap funds, they're like in between large and small cap. I mean, they have no leeway, right? They only have those, I don't know how many companies fit in that mid-cap criteria. So it's become a bit very straitjacketed. It doesn't allow the fund manager the flexibility to move based on their view of valuations. And valuations change in mid-cap, small cap, large cap, right? But very, very high allocation to large cap. Keep it as liquid. And between 15 and 17% return change over a long period, and it's okay, right? You can live with 15 and not 17 with that volatility. So,
well, I mean, that takes me to my memory. I was part of the only fund house in India which was into multi-manager and fund of funds.
yeah,
So we were too early at that time.
yeah.
But you mean to say that 4 or 5 funds are enough? That should do?
Yeah, I think so. Why do you need more? So you might have to diversify for style, right?
No.
If you like a value, but value funds can underperform for a long period of time and really test your patience, then you want to diversify from styles. But otherwise, if you're able to identify good fund houses with good investment philosophy and good fund managers over a long period of time, I don't think you need more than 5. Like I have 3.
That's all? Just 3 funds?
Yeah, I just have 3 funds. But I'm different. I can choose. I can stay. I know fund managers, some of them personally, right? I have money in my own fund, so it's different. But I don't think you need more than 4.
Okay. Yeah, that makes sense. I think too many
Just keep it
funds.
easy, right? I mean, how many SIPs are you going to run? Then how many SWPs will you have to run? That's why I still say, I mean, if there are good equity fund of funds, you just make one SIP, one SWP, one lump sum investment, you're done. You don't need complicate your life as much.
True. Sure. The next question is, let me take that next question. So it's, which one is better, SIP or one-time investment? I think it's a very it's a very tough question. I think you can't really compare SIP versus one-time. Both are different animals altogether.
Yeah.
From your regular income, whatever money you are intending to save, you want to bring in discipline. I think that is SIP. So never compare SIP to one-time investment. SIP is that your soldier which brings in discipline. It's like every day morning getting up and going for a jog. Okay, no comparison to that. In between, you get some bonus or some kind of lump sum money to be invested. I think that's also, you keep it separate. Definitely deploy to the market. When you're not sure about market conditions, I think STP is a better route. Put that money in liquid funds and then systematically keep entering. That would really give you some kind of discipline at the time of entering as well. So I think a good mixed strategies is something what one should follow. But don't wait for the money to be accumulated in your savings account and then go for lump sum. Probably that's a bad idea. Continue these two things separately. Treat these two things separately. That's what my personal take is. Next is a very interesting question, Arvind. I mean, a middle-aged person with minimal liabilities, what should be the ideal asset allocation? So someone with middle age with minimal liability itself is a very big achievement,
Yeah.
what I would say.
Happy man.
Very happy man. I think for that happy man, what kind of portfolio asset allocation would you recommend?
I'm saying middle age is 35, 40s, right? I mean, I don't think we tend to live longer today, right? So, this entire notion that as we go into 60s, we need lower equities. Maybe we don't. I mean, we need higher equities also. So, if you want the straight jacket answer, just follow that emergency corpus. Emergency corpus 80-20. It doesn't matter whether 35, 40, even at 50, I think we can still continue with that because you have that emergency corpus buffer and you have that gold allocation to protect you from volatility. So I think just be simple.
Yeah,
you don't have liabilities, which means that you have monthly savings. So if you can do that SIP, that discipline of monthly saving, and then build your corpus till your say 50, 55, then you can relook at your allocation.
Yeah, no, that's true. I mean, I think in general, while talking about generic statements, right? I mean, we tend to, but yeah, it makes a lot of sense for a middle-aged person with a limited liabilities. Yeah.
Yes. Yeah.
So next question is, I think, suppose if markets get corrected, whatever anticipation we have, it doesn't fulfill, markets get corrected. What should someone do? Should they still pursue on their goal, keep investing in equity markets, or there should be a change in strategy? Would you recommend some kind of rebalancing in the portfolio?
That's a generic tough one, but so if you've bought in March and April and May, right, those times when the markets were low, and you increase your equity allocation to slightly higher than what you want. I mean, now nobody's in that situation. Everybody is under allocated equity, but in your risk parameter, you thought you bought a lot and that doesn't, maybe that could be a time right now to kind of take some money away. because given the way the markets have just reacted, right? It's been a superb rally. So if you bought and if you allocated lump sum amounts of money in March and April, then maybe there is time to look at rebalancing. Rebalancing is also done when if you are following a particular pattern and you feel that, okay, I have maybe made way too much in equities. Maybe I need to reduce and get into I don't want that much risk today. So that's the way to look at it. But for general, Indians are underallocated to equities. Right? The amount of money that Indians have in equities is much lower than what they need to build wealth, what they need to beat inflation. So in India, generally for at least for some time, any market correction is an opportunity to increase your equity allocations, right? So think of it that way. So you, as I said, use the market opportunity as a if you are allocated only 10% equity and the market goes up by 100%, don't be happy. You should be very sad that you have only 10%. And if the market corrects, don't be very sad that my 10% is now down to 5. You actually make that 5 to 30, 40, 50. So that's the way you treat your market as a friend. And if you keep it simple and do this, it should be easy. And today mutual funds, I mean, as I said, I mean, the click of a button, you can do so many things on mutual funds, on platforms. So just use them.
So interestingly, I had a faculty member. Okay.
So I do believe, we do believe that markets are expensive, right? So from a valuation perspective, from equity, that market is expensive. But as I said, there is this flow of money that is driving markets. And if the expectation is that markets are going to, interests are going to remain low and money is going to come to emerging markets, markets may remain expensive for a very long period of time. We've seen that in 2006-07, when markets remained expensive for almost 2 years. 2014, 15, 16, after Modi came to power, markets were extremely expensive. Earnings went nowhere, but money was coming into Indian equity mutual fund. So, you keep that in mind. But if you've bought a lot and you're thinking, oh, this market has gone too much and my salary levels have actually gone down. I know people whose salary levels have gone down. I know people who still do not have good incomes, and the markets are that, that correlation if you made, and then you can take some money off. But otherwise, you're still under allocated to equities, right? How much percentage do you need to have and how much do you have? So for many, it may just be that you got it right, stay invested. So for many who have allocations, you got it right, you want to take off some money, fair enough.
Sure. No, of course, that really makes sense. I think the more when we overthink things is when we would end up making these decisions, we have a faculty member in one of the courses. What we do, like what he points out is students who are extremely bright are the ones who would fail in some of the exams, because for every question they overthink and then end up with the wrong answer. That simple strategy, what you mentioned, emergency fund and post that to 80-20, I think that's one simple strategy one could follow, or one should follow.
I'll tell you, it has benefited people who have doing it, and I've told it to my friends, and they didn't get hassled during March, and I saw that, both not from a markets but more from a personal perspective, right? Whether I'm going to get my salary, what am I going to do? So for many, it might be difficult to build that corpus itself because you don't have that kind of salary, but you also don't have that kind of expense. Right? Build that emergency corpus. It just clears your head and makes your life very, very simple and easy.
Sure. In the next question, it would be nice if you can throw some light on the debt funds as well. At the moment, debt sounds very safe. Like there's a perception game with respect to debt.
Yeah.
And when someone starts searching on the Google, like best performing funds, probably September, October, gilt funds would have come on the list as the best performing funds because of the rate cut and so on.
Yeah.
But now liquid funds are giving 3 point whatever, that kind of exciting. Yeah. The question is, considering market times, what kind of debt portfolio one should really look at investing debt funds?
So as I said before, the objective of debt is to not earn returns for you. It's not to earn excess returns. Right? You are investing in debt to keep your money as safe and liquid as you can and use it as a channel. So if you have money in a liquid fixed income instrument, like say a liquid fund, and then you have excess in that and the market falls in March, you can easily switch, right? You can do STPs, you can switch. That's one purpose. The second purpose is you don't want 100% volatility. You can't sleep. Like, I think today markets fell, right? So if you have allocated a large to equity, you always see the market and say, okay, markets are down 3%. My portfolio value, as ET will give, market cap eroded, Indians market cap eroded by 3 lakh crore, whatever that number is. So you need, because you want protection from that, you have debt. So when you build a debt portfolio, for even now, for a large proportion, fixed deposits may just be better than doing debt funds. Like, I am a mutual fund guy, I have debt funds, but I've always said this openly that, if you do not understand interest rates and exit loads and, expense ratios and mark to market and credit fund, just being a fixed deposit. I mean, there's nothing wrong. You might earn maybe slightly lesser in a tax adjusted basis, but maybe slightly more also sometimes. It depends, right? Uh, so I would say a large proportion of a fixed income portfolio should be in liquid funds. That's your emergency corpus. And then choose a debt fund or a fixed deposit or a dynamic bond fund, because then you are staying over a cycle in interest rates, right? Even if you look at FDs, many people do 1 year FDs and tend to roll it over. So they tend to be a long-term FD investor. So you can be a long-term bond fund investor. But just as you should not try to earn that extra 1 or 2% by investing in a small cooperative bank or a retail NCD, you can do it, but for a small proportion, something that you can lose and you don't, or you get stuck. It's not going to come back. They're defaulted, like Franklin funds, people invested there. It's not, the money is not available with them. If that was an emergency corpus, imagine what the situation is today, right? So don't do all those mistakes. You can make 5-10% allocation in of your fixed income. Also, keep in mind that when you do fixed income portfolio, you are already allocated to fixed income. Money lying in savings account is fixed income. Money in FD is fixed income. Money in your EPFO, if you're doing EPFO, is predominantly fixed income. 90% of EPFO is fixed income. So you already have fixed income exposure. The thing to ask is, do I need more fixed income or do I need more equity and more gold, right? And okay, then you decide, okay, this is what I want in fixed income, keep it safe. Don't 5-10% in credit funds or 5-10% in those retail NCDs, cooperative banks. Now the deposit insurance is high, so there is a lot of tendency for people to do, chala 5 lakh, so I can invest, where will it go? But the thing is, it's insured, but it might not be available to you when you need it, right? So keep that in mind. But debt is to keep it safe. Don't try to earn excess returns from debt. And again, very rule of thumb, this is not guaranteed. If you look at long periods of Indian interest rate history, rates have been between 6% and 9%. Right now, it's much below. Like, we are at decade lows, multi-decade lows.
So when you say 6 to 9%, you're referring to government securities, right?
Even FDs, right? Between, typically after 9, it kind of peaks. You don't get 10% for a long period of time. You get 9 and then it comes down, and you get 6 and now it's gone below. If COVID wouldn't have happened, we would have been higher. Rates would have gone up. If COVID has happened, inflation is high, but COVID has happened, and that's why rates are low. On a very rule of thumb basis, when interest rates go below 6%, below 5.5%, 6%, try to avoid taking too much risk. So try to be in safe, although you're earning less, but be in short-term fixed deposits, be in liquid funds. Your returns will be lower. Today, liquid funds are 3.5%. You can actually keep it in savings also, to be honest, right? You don't need, but which bank is safe, which bank is not. So then choose a liquid fund, which is, investing only government securities, treasury. So that's the, when rates go up. So when the interests are increasing. So if you think that RBI is going to normalize interest rates, 1 year hence interest rates are going to be higher, that is a time to not do long-term investments. So don't do long-term bond funds. Don't do long-term fixed deposits. Keep your investment maturity short. What happens is, in a liquid fund, right now earning 3.5%. If rates go up to 5%, you will keep earning that higher yield, higher accrual, right? Because liquid funds invest in very short instruments and they keep maturing. And on every maturity, the interest rates that when they reinvest, they reinvest at a higher rate. So at a very low market risk or limited market risk, you can get higher returns. If at 5% you do a 5-year FD, don't do that, because if interest rates are at 7% in 2 years' time, you're going to have lesser returns than you make. So when interests are low and rising, keep it floating, keep it in liquid, keep it in short-term fixed deposits. again, rule of thumb, when interest rates go above 8.5%, is the time to lock in. And when I say lock in, do long-term fixed deals, do 4-year, 5-year fixed deposits, or invest in bond funds, long-term bond fund, long-term gilt funds, because we've seen historically that whenever interest rates go above 8.5%, 9% repo rate, bond yields, it doesn't stay there. It comes down, it falls. Average, if you take average returns of any category of Indian debt funds, liquid to gilt, it's between 7 and 8. You take a 5-year returns, 5-year, 7-year return, it is between 7 and 8. So that's the range that you're trying to play. If you find all this complicated, use a dynamic bond fund. But then you have to live with that volatility of a dynamic bond fund. And you'll also have to invest at least for 2 to 3 years. And taxability in bond funds is better only after 3 years. So if you can take that volatility, and I can take it. So all my debt money is in a dynamic bond fund. I can take the volatility, I can time the market. And I know it is better taxable. I don't have money in fixed deposits. So, these are the ways to look at fixed income.
Sure. Thank you. I think fixed income is one market or one area is very less explored. We are just slowly, I think, scratching the surface with liquid funds. I think we have a long way to go with respect to understanding or penetration of fixed income or debt funds itself. But like you rightly mentioned, if an investor finds it very complicated, just invest in FDs. That also makes sense.
Yeah, absolutely.
There's one question, I think, in every session I do, what I come across is how do we select mutual fund schemes? Okay. The one individual is asking, I'm ready to do 20,000 rupees SIP. How do I select these funds? You said, okay, large cap, multi cap, mid cap, give that mix. But how do we select those funds? I think that's one challenge which everyone faces.
So it is much better now, to be honest, because now there are limited schemes per category. Like each mutual fund cannot have more than one scheme. In 2007 and till 2013-14, before SEBI became strict on this, I think at one point around there were some 2,000 equity schemes or something like that. When we started the equity fund of funds at Quantum, the number of funds just to pick and select, so it was very, very difficult. It's much better now. What we think and what I also do is you have to look at two things. One is, is there a long-term performance, and how has the fund done over a cycle, over a market cycle, right? Downturn and upturn. And if you think that they've managed the downturn well and they're participating in the upside, your equity fund need not be the best performing equity fund. Your equity fund should be the fund which is doing what it's supposed to do. If that fund is supposed to not underperform in falling markets and participate in a rising market, and fund managers, if you listen to fund manager interviews, they will talk about these things, right? So you don't look for that top performing. My fund should always have the top performing. That's not the objective. And the return differential is not very high between a top performing and a second quartile, right? Over a period of time. What you're looking for is consistency. Is the fund consistent in its behavior across cycles? It's not easily available, but you can look at Groww, mutual fund returns, trackers and all those performance related metrics that they put. The other is slightly more complicated, but every fund has a philosophy, right? Every fund follows an investing philosophy, and they will talk about it, they will write about it, and they will tell why I will do well in this period and why I will not do in this period. That one, if that communication is transparent and if you're able to access that, those interviews which happen in all websites, then look at that and look at the performance and say, okay, this is what the fund manager is saying and this is what the performance tracker got is. If it matches, mostly they have a philosophy, which means they have an investing philosophy and they're following it, and then back that fund. Otherwise, equity fund of funds. So that's a problem. But today, because information is available, right? 10 years back, so much information was not available. Today, you have RIA community, you have people like Groww, you have the other websites where so much information available on fund performance over cycles. It's all there. You just have to look through, and you get all these statistics, and you can all. One thing I tend to be wary about is staff fund managers. So if that
That is my next question. Like, then
is
should we really follow if if a fund manager leaves? Should we exit from that particular fund? What do you?
if you invested only for that fund manager, then because you like that person's style, and that's why you don't like the fund house, but you like the fund that he manages in that fund house, and so that means you're invested only for that. Then that's a tough call. So that's in India, you have that problem. I mean, there are a lot of star fund managers, and when they leave, the portfolio might completely change. We've seen that in many occasions. So that I'll need to be, if even if it's a star fund manager, do they have a dedicated process that somebody else can follow if they leave? That's a challenge.
Sure. So one last question. This is with respect to gold. Investment in gold. What strategy one should adopt now? An SIP kind of a regular investments, or I think prices are low enough or ripe enough to put in lump sum investments for someone to take that 80-20 rule.
Yeah, I mean, I'll repeat my answer that you should invest in gold and hope it falls, because again, you're not trying to earn from gold, right? You're not trying to time the market in gold. It is for a very specific purpose of managing your overall portfolio risk, right? So if you're very disciplined and you follow the 80-20, I have not done it. If you see my allocation, I have a very low allocation in gold, which means I am not done a regular investment in gold that I should have done along with my equity investments. Uh, then you're prone to timing or missing out a rally. If you're disciplined, then you can do that disciplined investments and have an SIP into a gold savings fund, or in between keep buying that sovereign gold bond fund. But again, in sovereign gold bond, remember that it's not liquid. It's very difficult to sell that asset. Gold ETFs are more liquid. Uh, I don't have a gold view actually. I mean, right now it's gold is caught in between a weaker dollar that move and interest rates. And so if say global interest rates start moving up, looks unlikely right now, but say it does, right? Then gold, the appeal for gold kind of goes down, because gold does well when interest rates are negative. When interest rates become positive, or positive real interest rates, then gold does not do well. It has done well very significantly over the last few years, but think of it in rupee terms, it has done well. But for a dollar investor, gold peaked in 2011 in 1900 or something, and it is around there. So for a dollar investor, nothing has happened in gold if they bought and held it. For an emerging market investor, like in rupee, it has done well. There could be some times when you can time it, when some sudden gold also is volatile. It's not, look at the price volatility of gold, it is actually quite volatile. So it may offer you chances to invest, but an equity like timing that I will do in gold. But if you're doing that timing in gold, then it's only for trading. Then you should also sell. Right? If you're doing gold only for your asset allocation, then just follow the pattern.
Sure. Sorry, I think there's one last question which I want to ask. I think
Sure.
with the broader market rally happening, do you see now value stocks picking up, because there's too much money chasing too few stocks? You think the value story is ripe for good recovery there?
It's too early to say. We are value managers at Quantum, and so we would want to say yes. It's too early to say, but if you take a 20-year period, value has done well. I mean, if you look at 20-year charts of growth versus value, India, we don't have a value index, so you can take the Quantum portfolio. But if you look at the MSCI growth versus value over a 20-year period, value has done well, but for the last 5 years, right? So in an environment of very low interest rates, easy movement of capital, technology stocks, driving that index returns, value has not done well, right? I think one positive trigger, I don't know whether it will sustain, is fiscal. So when government starts spending, like if you look at the decade of 2011 to 2019, every government was tightening fiscal, which means they were spending less, austerity as we call it, right? Every government was trying to reduce debt, they were reducing the fiscal deficit, which means the government is not spending enough. And when government spends, it tends to be distributive, right? And they spend for infrastructure, they spend for subsidies, which leads to consumption, which gets built in infrastructure over a period of time. And in that period, when the government spending increases, it tends to be better for companies in industrials, utilities, materials, commodities, very typical value segments, right? So if this entire fiscal increase, and I showed a chart of how much fiscal deficits have increased and how much governments are willing to spend, and as we've seen, debt on its own is not a problem, right? I mean, people are worried about debt and they should be, but when there is requirement to increase debt, all central banks have gone ahead and funded it. So if this continues, if everybody believes that, the world is very unequal, it requires that support. Many governments will have to support with incomes and expenditure for some time. Then it might be a situation where, all these typical value sectors, value segments do well. But it is still difficult to say. But over a long period of time, it kind of works out. The last 3-4 years have been very bad, but long term, value tends to do. And value also has that aspect of margin of safety, right? You're at all times you're trying to look for the margin of safety when you invest. And in times like March, or times like this, when maybe the margin of safety is not available, the value manager tends to hold cash, right? They just don't see value and they tend to hold cash. And that kind of plays out over a period of time. Last 3-4 years has been horrible. But if you look at 20-year period, it's worked out pretty well.
Sure. So thank you so much, Mr. Arvind. It was an absolute pleasure. Got a fresh perspective towards the asset allocation strategies. So thanks for joining in. And thanks everyone for joining in. Please, you can watch this video on the YouTube in the Ab India Karega Invest channel as well. So thank you for joining in. Have a good day.
Thank you so much.